Ladies and gentlemen, welcome to Destination Retirement with Robert Kuhn.
Time to get on board with Robert Kuhn from Kuhn Capital Partners. Retirement is a destination you've spent decades saving for. And what you do with those savings can make all the difference in the life you live once you get there. Income planning, wealth planning, tax planning. Destination Retirement with Robert Kuhn starts right now.
Welcome. I want to thank everybody for joining us this weekend. My name is Robert Kuhn, president and founder of Kuhn Capital Partners, SEC registered investment advisory firm, headquartered in Oak Brook. So if this is your first time listening to us, welcome. If you have listened to us consistently or more than one time, welcome back. I want to thank everybody for joining us this weekend. As you know, we are all about education, 100% education when it comes to investing. Our firm is headquartered in Oak Brook, Illinois. We are located right across from the mall, so if you would love to stop in, you can. We are at 1415 West 22nd Street, Suite 530. Get off the elevator, turn left, you'll walk right into the office, and we would love to see you. Lots going on this week, especially with the war in Iran, and we've had a tremendous amount of questions on how it's going to affect the market. So I thought we would talk this week about some of our strategies and how they are affected, good or bad, by it. But if you would like to learn more about our offering, more about what we are doing and why it is so unique, we would love to have that conversation with you. 469-525-3366, 469-525-3366. These times are unique. These times are different. These times are interesting. The market's going to go up. The market's going to go down. The market's going to go sideways. Really, nobody knows, obviously. And it is somewhat of a challenge. And as you know, if you've listened to the radio show for any length of time, our belief is that most advisors are just simply doing some sort of a balanced portfolio. Many individual investors are doing the same. And then when the markets go down, people realize that the protection that they thought they had, the protection that they thought their investment advisory firm was putting in place isn't there. And that is opening up a tremendous amount of conversations for us at Kuhn Capital Partners, not only our traditional offerings, but also our private funds, especially the energy strategy. Bison 2, we've had more conversations, more people reach out about that just due to the price of oil. So tax benefits along with, we would believe, strong targeted returns. Again, past performance is not indicative of future results. So anything we talk about on the radio, when it comes to tax, when it comes to performance, we're not licensed tax professionals. So best practice is to always reach out to your tax professional. Anything we talk about returns, they're just for informational purposes only. As you know, past performance is not indicative of future results. So 630-492-1912. The banknotes, they are pricing very strong, as you would expect with volatility of the VIX. Volatility of the market. The banknotes are now pricing over 14%. And so if you know what the banknotes are, well, you know what they are. If you don't know what they are, they're backed by the largest financial institutions in the world: JP Morgan, Citigroup, Bank of America, BMO, Morgan Stanley, UBS, Bank of Canada, BNP, etc. The list is long, but they are considered what we would consider to be the largest and most fiscally strong banks, and those banknotes simply track an index, generally 3 indexes, and they really simple. As long as those indexes are not down 30% on the monthly valuation, you get your coupon. So if it's 14%, simply divide that 14% divided by 12, and that's your monthly coupon. So as long as those indexes stay above negative 30% on that monthly valuation, you will receive your coupon payment. So met with our partners in that regard. We've done quite a bit of notes as a firm. So I think over the last 13, 14 months, we're close to 70 plus million in issuance. I love it because we had a lunch this week with the team and company that we use that aggregates all of the notes and has the relationships with all of the banks. We always talk about just why traditional advisors don't use the banknotes. And when we talk about the banknotes with our current clients, when we talk about the banknotes with potential investors, inevitably I don't know if it's 90% or if it's 100%, certainly not 100%, but more times than not, the response from the individuals that we are educating on the banknotes is, why doesn't every advisor talk about this? And that's a great question. And we as a firm talk a lot about it. We as kind of an industry talk an awful lot about it, because I believe the role of an advisor is to educate investors on strategies that they're not familiar with. Now, that doesn't mean that these strategies are new. I mean, these were cutting edge maybe in the early 2000s. They're a massive space. It's just very labor intensive to do. Very labor intensive to do at scale. And we would consider we do them at scale. So that's, generally why most advisors, simply don't talk about them. And you could put 10 advisors in a room and 8 of them probably have no idea, the inner workings of what they are. And I'll give you an example. So there's a big firm in Chicago, not too far from our office in Oak Brook. And one of my associates at our firm knows this individual, and they were out somewhere and having a conversation, and they said, inevitably it's, shop talk, like, what are you guys doing? How's business? Blah, blah, blah. And our partner said, we do a lot of banknotes and we do a lot of structured banknotes. And this advisor, I believe he's an advisor, said, oh, those are terrible. And it's like, are you kidding me? I mean, just to out of hand say, an investment is terrible, when he had absolutely positively no clue what those strategies are. And is it a perfect strategy? There is no perfect investment out there. But what draws people to the banknotes is the ability to still receive cash flow even in negative markets. And recently we've been doing, with this recent volatility, we're still doing 30% on the downside for the coupon and 40% of the downside for the principal. And when you can tell a client that they're going to get, currently 14% annualized, broken up into monthly payments, as long as on the valuation date of each month that those notes or those indexes are not down 30%, that's a really strong story. And who is some young advisor to say anything is good or bad when you have absolutely no clue of what the strategies are? And I see it far too often in this industry. And I don't want to get on my soapbox, but sometimes I do. I mean, I am 51. I have been in the business for almost my whole adult career, my whole adult life. And I see it over and over and over again that advisors are still doing 60-40, 70-30, basic stuff for people on the radio. They're pitching these lifetime income annuities, and that's all that they're doing. And it's such a challenge, and it's such a challenge for me, because we're trying to change the industry of just education. It's the job of an advisor to educate. It's not the job of an advisor to sell, to push. And we see so many people on the radio that are selling these annuity products, because guess what? They pay a fat commission. They pay a significant commission, 6, 7, 8, 9, 10%. And it's simple math. You do 10 million, you do 20 million, you do 50 million, you do 100 million a year. You guys can do the math. And so when you meet with somebody, you have to ask if they're certainly pitching a single product. Figure out their objectivity of offering that strategy. And you have to ask them what percentage of your revenue is made up of this strategy. That's a very, very fair question to ask. And I strongly suggest you ask that, and ask us. Anything we talk about, ask us. And we'll gladly either give you an approximate number, or if you want to know the exact number, we'll just do the math. So when you put 10 advisors in a room, 8 advisors have no idea what a banknote is. One advisor may, talk about it super high level, but I can tell that he has absolutely no clue. And then you got one guy that, may have an understanding of it, or gal that has an understanding of it. So the banknotes are obviously, in a market like this, are still pricing really, really strong. Our Bison 2, our energy fund, so our private energy fund. Again, you have to be accredited to invest in it, $1 million net worth, not including your primary residence. It's offered by an offering memorandum. So on the banknotes too, let me go back to that for a second. If you have any interest in them, call us, 469-525-3366. Get the educational material. Get the prospectus of a note that we have done in the past. Read it. Really read it. Put it in ChatGPT. Put it in your favorite AI. Ask it, what is the pros? What are the cons? And then come back to us with some education or some questions so we can really see if it fits ultimately what you're doing or looking to do. And then on the with the price of oil doing obviously what it is, and we'll talk a lot about that today, the Bison 2 strategy, again, which is offered by an offering memorandum. If you have any interest in it, call us. Get the offering memorandum and read it. Put it into ChatGPT. Do whatever you have to do with it so we can have an educated discussion on why it can or it can't make sense. And the benefit of that is of a fund is the fund already has assets. The fund already has significant cash flow. The fund already has assets that were purchased at much lower oil prices. So when you look at what's going on in the world today, yes, the oil and gas fund, the energy fund, it is such a simplistic fund, but yet not simplistic, and so it's one of those things that, yes, it's really easy, but, the access to the deal flow, the access to the structure is very, very challenging for an individual. They couldn't do it. And it's even challenging for us to have set up, but we did, and we've had a lot of tremendous success with it. So on the tax side, again, we target $80,000 per $100,000 invested as a tax benefit against active income, passive income, W-2, 1099, whatever. Again, not tax professionals. Bring your accountant in. Your tax professional will have a conversation with them. That's obviously always a best practice. But the tax benefits are significant, and the cash flow is significant. But the benefit of the fund itself is when you own a fund, you own a piece of the fund which already owns assets. So that is what is really appealing to people. So we're going to talk an awful lot about that. Today, we're going to talk about the markets. We're going to talk about the banknotes. We're going to talk about financial planning. We're just going to talk about what we're doing in the marketplace today and a level of uncertainty that I probably haven't seen in 26, 27, 28 years or however long I've been in this business. So 630-492-1912, 630-492-1912. More after the break.
Retirement looks different for everyone. Will you be sitting on your porch taking in the view, or will your porch be disappearing in the rearview mirror? Whatever your retirement dream, making it a reality starts with a plan. Robert Kuhn at Kuhn Capital Partners can help you create a financially secure and tax-efficient plan that is tailored to you. After all, you deserve to live your dream. Call 630-492-1912 and start planning for tomorrow and every day after. 630-492-1912 and visit us online at KuhnCP.com. Are you close to or already in retirement, and maybe you're not sure if your retirement plan is working as you'd hoped? Getting a second set of eyes on that plan is always a good idea. Call Robert Kuhn and his team at Kuhn Capital Partners for your retirement review. They'll be glad to sit down with you and talk about where you want to be in retirement and how to get there. So call today to set up your visit, 850-495-3033, or find out more at KuhnCP.com. That's KUHNCP.com.
Welcome back. You're listening to Destination Retirement. My name is Robert Kuhn, president and founder of Kuhn Capital Partners. A lot going on at the firm, headquartered in Oak Brook. Trying to get a lot in this show, so if I'm talking a little faster than normal, I apologize, but there's so much going on. So banknotes are pricing really strong, north of 14% annualized with 30% downside on the coupon. So as long as the index that note tracks is not down 30% on the monthly valuation, you get the coupon payment. Obviously, it's a strong, very, very strong story. If you have any interest or you have any concerns about your current portfolio, if you have concentrated stock and you want to look at how you can sell some of those positions and utilize Bison 2, our energy strategy, to offset some of those capital gains, we certainly are doing a lot of that right now. Roth conversions, high wage earners, you have a seven-figure, multi-seven-figure IRA, and you've been told by traditional advisors that Roth conversions doesn't make sense. Well, it may not, but if you can use Bison 2 to offset some of that additional income with the tax benefits that the fund offers, well, all of a sudden it may make sense. So 630-492-1912, 630-492-1912. Reach out. We'll have a conversation. Again, anything tax related is for informational purposes only. We're not licensed tax professionals. Best practice, always bring in to the conversation. Loop your CPA or your tax advisor in, and we can have a conversation. So, but here was I talking about? So, on the market, on what is going on in the world today, maximum uncertainty. Absolute maximum uncertainty in the market. I don't think the markets have priced in the risk that is going on. I think the government says they're not holding up the market. The government says they're not artificially keeping down oil prices. Maybe you believe them, maybe you don't believe them. We have all have our opinions. I can just tell you that the divergence of especially in oil versus Brent versus WTI, which is what we're most focused on. WTI, which is West Texas International, our intermediate, is a that is it's at an all-time high. So who knows? Who knows what's happening? But our job as advisors is to, I mean, if you think about and relate what we do to kind of football, most plays in football are designed to score a touchdown. They are. I mean, I think if you ask a coach, they want every single play to score a touchdown every single time. But we know that's not reality, right? And when it comes to investing, the markets, we were talking an awful lot, in really the beginning of this year, end of last year, that the markets were, in our, or at least our belief, the markets were priced to perfection. And that if you look at the valuations of the markets where they were, history tells you that your forward 10-year number at the current valuations earlier in the year, that your annualized 10-year number, the returns just weren't good. Generally between 2% on the positive side, negative 2% on the downside. And so you have to, as advisors, adjust to what is going on in the market. And that is what I have found that is so wrong with the individual investor space, kind of those that are working with individuals in that $1 to $20, $1 to $30 million space, is that you're getting, generally speaking, the same investment strategy, a buy and hold strategy, a balanced strategy, a 70-30, 60-40 type strategy that has really no defense, really, no strategies in place that can do well, protect, still produce positive returns in negative markets. And so that is, I think, why we have had, so much interest in our offering. Simply because, we have distinct strategies that we believe something can work no matter what's going on in the market. Doesn't mean that they always will, right? But you have to give yourself many outs. And when we talk about outs in what I am referring to are strategies that can do well, i.e. the banknotes. I mean, can you, not get paid a coupon in the banknotes? Of 100% you can. If those indexes that the note is tracked to are down 30% or more, you don't get paid a monthly coupon. And in some of our notes, we use KRE, which is the regional bank index. We're not super close to 30% right now, but in some of them, it's down 15. The KRE is down 15. It's down 20%, depending upon when the note was priced. And so we have to start paying attention to that, meaning if it ever does hit that negative 30, then you're not going to get your monthly coupon for that, month. But when you're getting 14% annualized, so what if we miss 2%, 2 coupons? So what if we miss, 6 coupons, right? I mean, you're still, producing positive cash flow. And I want you to compare that to the lifetime income annuities. I want you to compare that to the lifetime income annuities. And we can have a very educated conversation on which is going to produce more cash flow. Because what I have found is that the lifetime income annuities, most of the advisors, certainly on the radio, they're suggesting that you defer it. They're suggesting you defer the income for 3 years, 5 years, 7 years, 10 years. And the illustrations that you're being sold are back-tested hypothetical performance, and it's not real performance. And they look just ridiculously good on the returns, but in the real world, they're nowhere close to that. And then obviously, the insurance companies put a governor on how much you can take out. And so we want to compare cash flow, apples to apples, who can produce more cash when it comes to the banknotes or the lifetime income annuities. Let's do it. Let's have a good, educated debate on that. Now, the annuities pay big commissions, and I think that's why so many individuals, so many advisors who don't have a kind of an advisory practice, which is, like what we have, which we have multiple strategies. We're not going to come in and just pitch one idea, one strategy. I think that's what really drives many advisors to doing them, unfortunately. And then, of course, as we talk an awful lot about, and we have a debate, inside of my firm as well. Like, people say, well, you guys don't like annuities. That couldn't be further from the truth. And one of our, what I think one of our greatest strategies for people who have significant nerves or are very worried about, the market is the 5-year index annuity. But here's the difference. It's very short-term in duration. Yes, it pays a commission. I don't know what it pays us, 5%, 6%, or 7%, something like that. I wish it didn't. I'd rather take a fee, but as I've said, multiple times on the radio, how I'm compensated and our firm is compensated shouldn't affect how or what strategies are being shown to the investor. And so the 5-year index annuity is phenomenal. I mean, it's short term, and it is tied. The ones that we use are tied to the S&P. Now, the downside is you don't get the dividends, so it's the price movement. But anything on the downside, your return is zero. So if the S&P is down, 5, 10, 20, 50, 100, whatever, your return zero. And currently, there's a cap on the upside. Those are the ones that we use, capped on the upside. And the current cap is 10.5%. There's so many people listening to this radio show that would love to see how that could fit into a plan for some safe money as a hedge to what's going on in the equity markets. And it's very simple. When you get a gain, the gain's locked in. And so there's a debate in our firm that, do we use the banknotes or do we use the index annuity? And the reality is everybody's different. Every client's different. And there is pros and cons to both. And so why not use both? Why not include both strategies? Because the downside to the index annuity is there's a surrender charge. So you have to go in thinking 5 years. Now, it's liquid. You could sell it, but you're going to get hit with a surrender charge. And I think the first year is, I don't even know what it is, 7, 8, 9%, but it declines over that 5-year period. And so these are the things that you have to know. And these are the things that I think separate us from many other kind of firms that of our size and that are much bigger than us, is that many advisory practices do not show the index annuity strategy because it pays them a commission. So that's not done, with our advisory hat. That's done as our role as a insurance agent, in which we have those licenses, of course. But, again, how we're compensated should not affect what we show a client and not affect what, an overall plan is. That should just be a piece of the pie, right? It should just be a small piece of the pie or a big piece of the pie, depending upon your situation. But it all starts with that plan. It all starts with the financial plan. And one thing that, I really adhere to is radical transparency. It's something that I talk an awful lot about in my personal life. It's something that I talk a lot about at the firm, is radical transparency. We have to disclose everything that we perceive as a positive, everything that we perceive as a negative. And when you can do that, investors' guards come down, because here's the reality. We don't need you as a client. That is just the reality of the situation. Our business is good. Our business is mature. Everything is, we're very pleased with where we're going. Now, I don't say that to be arrogant, but it allows us a level of objectivity that, I think many firms just don't have. And we're okay at whatever growth rate we have as a firm. If we're doing our job of educating, if we're doing our job of looking at your tax situation, looking and running your RMDs, which most advisors won't do, running your RMDs, especially if you have a multiple seven-figure IRA, running your RMDs out to age 95. Now, you may not live to 95. Obviously, nobody knows how long we're going to be on this earth, but having that plan in place and in looking at the RMDs, the tax that you're going to pay on those RMDs if you have a large IRA is astronomical. And I guess let taxes be your worst problem, of course. But what if we could mitigate that? What if we could put a plan in place that we could mitigate that? Those are the things that we want to talk about. So 630-492-1912, 630-492-1912. I'm going to tell you a story about somebody that we talked with last June, why they didn't come on as a client last summer, and why now they are coming on as a client. Again, these are things that I want investors to hear because it's real life. So give us a call, 630-492-1912. More after the break.
Are you close to or already in retirement and maybe you're not sure if your retirement plan is working as you'd hoped? Getting a second set of eyes on that plan is always a good idea. Call Robert Kuhn and his team at Kuhn Capital Partners for your retirement review. They'll be glad to sit down with you and talk about where you want to be in retirement and how to get there. So call today to set up your visit, 850-495-3033, or find out more at KuhnCP.com. That's KUHNCP.com. Retirement looks different for everyone. Will you be sitting on your porch taking in the view, or will your porch be disappearing in the rearview mirror? Whatever your retirement dream, making it a reality starts with a plan. Robert Kuhn at Kuhn Capital Partners can help you create a financially secure and tax-efficient plan that is tailored to you. After all, you deserve to live your dream. Call 630-492-1912 and start planning for tomorrow and every day after. 630-492-1912 and visit us online at KuhnCP.com.
Welcome back. You're listening to Destination Retirement. Hope everybody is enjoying basketball. We're big sports fans. We love March Madness. We love all sports, actually. It's so funny. When we were going through COVID, I was going through like sports withdrawal, right? And I remember finding a cherry pit spitting contest on TV up in Michigan. Literally seeing who could spit a cherry pit the farthest. I know it sounds crazy, right? But that actually existed. So if you're a sports fan, this is a great time of year. March Madness obviously is so much fun. Hopefully your brackets, it's the weekend, so hopefully it's not completely blown up yet, but we're just like you. We love watching sports. So 630-492-1912, 630-492-1912. If you have any questions, if you want to challenge your advisor's current thesis on the downside, on the risk management side, now is a good time to really check to see how much protection or how much quote-unquote defense you have in your portfolio. Markets obviously have been going down with the volatility in the markets due to the war. Now is really a good time to see, is your advisor just giving you lip service, or do you actually have things in your portfolio that are holding up? And if you don't, or if you were told something that is not the case, let's challenge that thesis and let's see if we can help you. So 630-492-1912, set that call up. So before the break, banknotes, we talk about it every segment, still pricing really strong, 14%. I think we've been over 14%. And again, past performance isn't indicative of future results. It's a prospectus item. We always encourage you to read the prospectus before you invest. These are just basic best practices that we're going to talk about, that we're going to suggest, that most people on the radio are not going to do that. But they are still pricing, not still. I mean, I guess few weeks ago, before the war, they were kind of in that 11 to 12% range, but with the volatility that's picked up, it's been over 14% annualized. And you get those broken down into monthly payments. So just take the current annualized price and then divide it by, or coupon payment divided by 12, and that is your monthly payment, as long as the indexes that note tracks are not down 30% from issue. They look at it one time a month, and the only thing that matters is what the indexes close at during that day. As long as they're not down 30% or more, you get paid your coupon payment. So those are really strong. Obviously, the big banks, we've been doing a lot. JP Morgan has been pricing very, very strong lately. So that's been nice to see. But all the big banks are offering them. And so if you have an interest, if you've heard me talk about it and you want to learn more, obviously with the volatility in the market, notes are pricing good. Let's have that conversation. 630-492-1912. A lot of people are starting, a lot of people have been reaching out and utilizing us as a satellite manager just for the banknotes. And that's fine. I mean, again, when you are crafting a portfolio, it's not our agenda, it's your agenda. And so we don't have to manage 100% of your money. If you want to use us just for the banknotes, great. If you want to use us just for the energy fund, fine. If you want to use us for our hedge fund strategy, which I believe is sitting 45% cash today. I haven't gotten the latest update, but I know last week it was around 45% cash. Again, active management, inflection investing, take advantage of volatility. Doesn't mean it can't go down. I mean, we've been hit with the market just like anybody, but we are sitting with a significant level of cash position inside our hedge fund. Those are the things that we want to share with investors. And when you look at our philosophy of protected growth, and then tax and alternative, those are the things that we're talking about. And when I talk about having outs, again, having outs means you have strategies in place. For example, the 5-year fixed index annuity. It's guaranteed against loss. Now, it's not FDIC insured. It's not backed by the government. It's backed by the insurance company. So you have to make sure that the insurance company obviously is well capitalized, good credit rating, et cetera. But that's an out. That is a strategy that we utilize. It's tied to the S&P. Really, I can't envision us not using a strategy going forward that's not tied to the S&P, but I can't make that definitive of a statement on the radio because maybe some index comes out that it is new and it's something ridiculous and you just have to use it. But the bulk of our stuff is tied to the S&P, which negates my biggest concern with these index annuities, especially on the lifetime income annuity side, is that the indexes are hypothetical. They're so new. They show back-tested performance on the these illustrations. And of course, if an advisor is selling you something based on an illustration, now the disclosures are good in the illustration, okay? I think that's phenomenal. But inside those disclosures, it's going to show you that it's back-tested and the index is, hasn't been around for X period of time. And so the returns that they show versus the real returns that index has done in live real performance, generally the deviation of that or the divergence is so significant. And so that is an out though. And again, I'm going down, a rabbit hole, but having that 5-year index annuity that's tied to the S&P, currently capped at 10.5%, nothing on the downside, again, backed by the insurance company, not FDIC insured, that's an out. To have a bucket of money that that's not going to go down, but it's going to go up to a certain level, it's certainly not there to replace equities. Maybe it's there as just a pure cash hedge. Maybe it's there because, whatever cash is paying isn't sufficient enough. Or maybe it's there to offset bond, as a bond replacement, which is generally what we look at because you look at where, bonds are, the returns that bonds are generating today. And my opinion, my belief is that it's just not worth the risk. I mean, go look at AGG and look at the 10-year annualized return on a bond strategy. It is nothing after inflation and taxes. Maybe it's negative. And so, but yet advisors, that's what they do. Why? Because it's easy. Why? Because the investor knows it. But that's not how we work. So the, where was I? Okay, I want to tell you a strategy about a listener that we met with last year. And this happens an awful lot because, again, it's not my agenda, it's your agenda. It's not my time, it's your time. When you see a need to make a change and interview us and potentially hire us, we're here, 630-492-1912. When you see a need, when you see an opportunity to test your current advisor's thesis of asset management, which there's no better time to test it in the markets right now. Now, unfortunately, you tell an advisor, hey, what gives? I mean, we talked about downside management. We talked about strategies that can do well when the markets don't go down, and those strategies will go up, et cetera. Well, they're going to get defensive in many instances, or maybe not defensive, but they're going to say, well, it's just time in the market. Don't worry about it. Well, duh, of course it's time in the market. Markets always go up. That's simple math. Markets always go up. It's just at what level and how often does it take for you to recoup your losses, because it's simple math. You're down 20%, 25, 26, 27% just to get back to even. Well, that's opportunity cost if you're losing a significant amount of money. But more importantly, if an advisor tells you that it's time in the market, well, if that's your only risk management strategy, then why are you paying their fees? Seriously, why are you paying their fees? Go to Schwab, go to Fidelity, sit with somebody once a quarter, twice a year, whatever, do an asset allocated model. Now, I don't think that's the way you manage money. That's not, in my opinion, the best way to manage money. But that's your right. So when we look at this time in the market, our clients understand what they have inside their portfolios that will do and what will deliver when the markets are down. Now, the bank notes, we talk an awful lot about them, and yes, they're still pricing north of 14%, but they do trade every single day. So there is a daily price on the bank notes. And for clients that, are listening, and for potential, future clients, if you put in 100,000, very rarely is your principal going to stay at 100,000. If the markets are down, you're going to see that principal value go down. Now, if you don't sell it, it really is irrelevant, because you're paying less in fees. B, you're getting your distribution always on, or your interest payment always on the original investment, not the current investment. But we have to show, and it's not us, it's Schwab, and probably an SEC related thing, but we have to show a daily value because they are liquid. If you were to sell it, that's what that is going to bear in the market. So inevitably, when we go through periods like we're going through right now, clients are going to call and say, hey, we put in 100,000, 500,000, $1 million, $2 million, whatever in the bank note, and it's down. Okay, fine. If you're not selling, what does it matter, right? Because it's always going to be called when it's called. And I'd say, it's going to be called for the original investment, original principal. You're always getting your coupon on the original principal, and you're paying a fee on the current value. So it's those are the things that I think we need to do. Even our firm, we need to do a better job. And we always tell clients, before they work, or when we're going through kind of the vetting process, that the bank notes are going to trade. The bank notes are going to go up. The bank notes are going to go down. But again, if you're not selling, we're not buying them to sell them. So you're going to see that deviation in principal value, but it sure is pretty nice that if the indexes aren't down 30%, you're still getting paid. And then when it gets called, you're getting it called for the original principal. So our job is always to try to be the best educators. Like I mentioned, inside of our Bison Alpha hedge fund, criteria there is $2.1 million net worth, not including your primary residence, or have $1 million with us. If you have $1 million with us, then that makes you a qualified investor, so you can invest in it. And right now we're sitting significant high levels of cash, and you can do that, and you can use cash as a asset class when you run a fund. It's very hard, and that's one of the reasons most advisors don't utilize cash, is because unless you can click a button, so everybody inside the hedge fund, it's so easy for us to manage. We click one button, the fund immediately goes to cash. But when you have thousands of clients that you have to individually go in and raise cash, unfortunately, that's why most advisors don't do it, because it's an operational nightmare. So the hedge fund, which is our fund, is sitting a very high level of cash right now. We would consider it to be high level of cash. And again, not trying to make macro, in and out calls. It's just defensive, right? I mean, goodness, the craziness in the world today, that strategy, there is a performance fee on the hedge fund. And so, we want to make sure that, we are doing all we can to protect that principle. So, up against the break, anything I talk about, if you have an interest in, give us a call, 630-492-1912, 630-492-1912. And I am going to finally tell that story about the investor that we met with last June. So more after the break.
Are you close to or already in retirement and maybe you're not sure if your retirement plan is working as you'd hoped? Getting a second set of eyes on that plan is always a good idea. Call Robert Kuhn and his team at Kuhn Capital Partners for your retirement review. They'll be glad to sit down with you and talk about where you want to be in retirement and how to get there. So call today to set up your visit, 850-495-3033, or find out more at KuhnCP.com. That's KUHNCP.com. Retirement looks different for everyone. Will you be sitting on your porch taking in the view, or will your porch be disappearing in the rearview mirror? Whatever your retirement dream, making it a reality starts with a plan. Robert Kuhn at Kuhn Capital Partners can help you create a financially secure and tax-efficient plan that is tailored to you. After all, you deserve to live your dream. Call 630-492-1912 and start planning for tomorrow and every day after. 630-492-1912 and visit us online at KuhnCP.com.
Welcome back. You're listening to Destination Retirement. My name is Robert Kuhn, president and founder of Kuhn Capital Partners, SEC-registered investment advisory firm. We're a fiduciary. It's important, we think. And if you listened to us before, phenomenal. Thank you. Welcome back. We're trying to repurpose this radio show. Obviously, we podcast every single episode, but we're trying to get out more education. Because in times like this, investors need to be educated, and the job of an advisor is to educate the good, educate the bad. Don't just lay a chart of 100 years worth of time horizons that, the markets do X. Well, 100 years worth of data doesn't mean anything to you. I don't think it should mean anything to you, at least if you're 50 or older. I mean, because we can see periods of significant market weakness. Look at Microsoft. If you bought Microsoft in 2000, even including reinvesting the dividends, it took you 14 years just to get back to even. Don't believe me, just run a chart of Microsoft. Now, the astute investors, which I know a lot of people that listen to my show, our show, are the smart investors. They're going to say, well, you're cherry picking a start date. Well, of course. Yes, we're trying to show you that if you invest at the wrong time, if you invest at times where valuations are high, it could take you a significant amount of time to break even if the markets go down. And who's to say that we're not in that period of time now? So you have to look at both sides of the coin. Now, if you invest after '08, if you're smart enough to have gone to cash before the crash or a big meaningful downturn in the market, and then you invest, you're blowing away the market, right? And if you're that good, we need to talk, because I want to hear what you're doing. I want to hear your models. I want to hear mathematically what you're doing. And we'd love to have that conversation as well. So 630-492-1912, 630-492-1912. Banknotes, as we talk an awful lot about on the radio, given the fact that I think they're so critical. It's such a strong cash flow generator. It's such a strong ability to still produce positive cash flow, even in negative markets, as long as the markets or the indexes aren't down 30% that note is tracking. There's now pricing over 14%. If this volatility stays, they're going to keep pricing this high. If it doesn't, they're going to go back down to lower levels. But they are currently pricing. We would consider to be 14% with 30% downside before you don't get paid a monthly coupon payment to be pretty significant. So again, it's a prospectus item offered by what we would consider to be the largest and most stable banks in the world. Just call us, get a prospectus of the last note that we did, so you can educate yourself. 630-492-1912, 630-492-1912. Energy, everybody's trying to figure out how to get into energy, of course. Why is that? Oil prices are going to the moon, but I have to caution you. Maybe the war ends immediately and then oil prices plummet. Now, I don't think that's going to happen. That's not our base case. I think so much destruction has been done in the supply chain that oil prices are going to stay elevated for an extended period of time. If you have listened to our show, we run a private fund, Bison 2. It's a partnership that invests in projects of the majors in the Permian Basin, very, very, very well diversified. So the Exxon, Chevrons, Conocos of the world, we're taking pieces of their deals Big tax benefits. Obviously, we're not tax professionals, can't provide tax advice. Loop in your CPA. That's always the best practice, but those strategies provide significant tax benefits. A lot of people are trying to figure out how to get exposure to energy. Well, this may be a way to do it because the current assets in the fund that are cash flowing and going to be significantly higher cash flow at these oil prices, the current assets that we own, 49 producing wells, we've got I think 170, 150 potential upside wells on the acreage that we own. They were bought at much lower oil prices. And the benefit of the fund is you get to benefit from that today as if you were an investor in day one. So that's something to consider. We have to look at it. It is illiquid until we have an exit. So that's something to obviously consider. You have to be accredited, minimum net worth of $1 million, not including your primary residence. There's risks. There's things that we have to talk about. But it is looking like where current oil prices are, it is shaping up to be just better than what we thought. And so it's something that if you have an interest, if you're a high wage earner, we're seeing a lot of individuals who have significant capital gains, probably watching a lot of those capital gains go down, especially in the tech sector. I can't tell you how many people we've met with that have, the Mag 7 that, took $1 million to $5 million to $15 million to $20 million, whatever. And unfortunately, they're going down, and they don't want to make changes because of the capital gains. Well, let's talk about a way that we can mitigate that, and let's loop in your CPA, and let's really come up with a plan and utilize the tax benefits of private oil and gas investing. So 630-492-1912, 630-492-1912. Sold a building, sold a practice, you're a high wage earner. We're actually, starting a club. It's gonna be the Bison Club. Once a month, we're going to have at our office. So a meeting. We're gonna have one during the day. We're gonna have one during the evening that goes over tax mitigation strategies, and we're really going to dive into tax mitigation strategies. And so we're just about to launch that. Hopefully, our first event will be in April. $5 million net worth, or not actually net worth, $5 million investable assets to be included in that. But that is something that is going to be new to us. Now we work with investors of all sizes. So, but that specific club, that specific those specific lunches or dinners or whatever we have at our office are going to be for $5 million or more. So 630-492-1912. Now, you don't have to invest $5 million. You just have to have $5 million of investable assets to participate in it. And it's a small group, just in our conference room. And I think our conference room holds, 10 people. So it's going to be a small group, but we're going to do it. Have 2 sessions a month, and it is for people that really are concerned with taxes and really want assets or investment options that are not correlated ultimately to the S&P 500. So Bison Club. So if you have interest in that, you want to get on that distribution list, just call 630-492-1912. And whoever answers, Paige, Carrie, whoever, just say you want to be added to the Bison Club distribution list, and we'll certainly do that. So, okay. So I was a client last year. Client loved our potential client. Actually, he's now coming on as a client. But we met with him last year, loved the strategies, loved what we were doing, thought it made a tremendous amount of sense, but didn't hire us at that time. Didn't hire us at that time because the markets were going up. And now when the markets are going down, the relationships rekindle. Hey, those strategies make a lot of sense now. And it really, now to his credit, he was very honest, very transparent. The markets are going up, kept going up. I didn't see a need to make a change. Now I do. And I get it. I 100% get it. And maybe I would do that if I wasn't in this industry. That is just human nature. And now to his credit, phenomenally smart person, very successful individual. And they recognize now that, now markets changed. Now we need to utilize what you guys have shared with us, over the last, really almost better part of a year. So I totally understand it. But that being said, if that is you, don't wait for a major downturn to stress test your thesis, stress test your advisor's thesis, stress test your current portfolio, your cash flow scenario. Don't wait. And yes, that sounds very self-serving because it's, trying to tell you to call us, but we're not a high pressure group. We want to educate you. We want to have a conversation with you before stuff really bad potentially happens. Oil today, I don't know why, WTI is still, at, around 97, 98, where Brent's at, 118, 119, when overseas it's 150 to 170. Something's going on. If oil prices stay high or blow out and continue to increase, my goodness, this market could crater. You don't hear me say that a lot on the radio. We're not doom and gloom guys, but you have to be protected. You have to be protected now more than ever. So now is a great time to challenge that thesis. If we've talked in the past and for whatever reason it wasn't the right time for you at that time, great. It's okay. Again, it's not our time. It's your time. Reach back out. Let's have that conversation. Let's really let's go down that path again of what we're doing, why we think that our offering stands out. We think our offering is towards the top. Even if you're working with a family office, even if you're working with a big bank, a big brokerage firm, we know their offerings. Well, especially we know what they can't do at the big banks and big brokerage firms. I mean, that is pretty easy. But we know that stuff. And so we want to have a conversation with you. We want to be the best educators that you've ever met with. We want to educate you on pros and cons of different investment strategies and craft a portfolio that can deliver something, has the ability to deliver no matter what's going on in the market. You have to, the word is caution, because everybody's so conditioned to buy the dips and then they are 20, 30, 40, 50% higher. That may not be the case this time. It could be, but it may not be. But we don't want your success to be determined by having to have that happen. So that's what we're doing. Those are the conversations we're having. Obviously, they pick up in volatile times. I understand it. I wish they picked up more when the markets were significantly high so we could lock in some of those gains. And you don't give those gains back, but we understand human psyche, and we're all victim to it. So if we can help out in any way, we'd love to have a conversation with you, 630-492-1912. If you like what we're saying, we do podcasts, this radio, send the link on to the radio show. Send this link on to somebody that needs to hear the story. That's about as aggressive as we're going to get of asking for referrals. So until next week, 630-492-1912.
This recording is for informational purposes only and should not be considered investment advice. Kuhn Capital Partners does not provide legal, accounting, or tax advice. Any statement regarding such matters is explanatory and may not be relied upon as definitive advice. Opinions expressed are current as of the date of this recording, and such opinions are subject to change. The views and opinions of guests on this program are not necessarily those of Kuhn Capital Partners. Any reference to guarantees, principal or income, protection, buffers, or defined outcome investments are generally structured notes or fixed insurance products backed by the claims-paying ability of the offering company and are not insured by any government agency. Kuhn Capital Partners is not affiliated with any guest unless otherwise stated and does not guarantee the accuracy or the completeness of any data presented. Kuhn Capital Partners and its affiliates are not responsible for any trading decisions, damages, or other losses resulting from or related to the information, data analysis, or opinions in this recording. Past performance is not a guarantee of future results. All investments are subject to investment risk, including but not limited to the potential loss of principal. Advisory services are offered through Kuhn Capital Partners, LLC, a registered investment advisor.